Ticker is ONON, stock is OnCloud. They make wonderful running shoes. The stock has been terrible, down 25% just this week on earnings, down here at 30 bucks. Is it cheap? Is there some value? We think there might be. Here's 2 minutes on what's going on with OnCloud in the short, medium, and long term. Let's take a look at the past, and this is why investors loved and gave a very high multiple to OnCloud. It's this top line growth. 29%, 30%, 29%, that's the last 3 years, right? Take a look at what happened in the quarters, though, to make everyone really worried that growth is subsiding on the top line and this is becoming a more mature shoe company like an Adidas or Nike. So remember that 29% annual growth? Well, investors, especially growth investors, love 20% top line growth and hate below there. It doesn't make any logical sense, but it's a really important inflection point for growth. And take a look at what happened over the last 3 quarters in OnCloud. 23% growth a couple of quarters ago became 14% last quarter, big down move in the stock, and 13% this quarter, big down move in the stock. 20% growth is no longer the norm as of the last 2 quarters. Let's take a look at what's expected for the future and what's probably needs to happen for OnCloud to turn around and get a better multiple. So let's go back to the annuals here. And this year was supposed to grow at 29%. You saw those last 2 quarters at 13 and 14. So a big inflection for Christmas is expected. And then now going forward, growth is expected to be 19 or 18% top line. But we just had 13 or 14% top line, right? So if these future numbers are too high and the new norm for OnCloud is to grow at 13 or 14% going forward, Wall Street has numbers too high and they have earnings per share too high most likely because of it. So these numbers, which make OnCloud look very cheap on a PE basis, might be a little bit high, especially if you see 13 or 14% top line versus the 19 that are in the models now. So despite all that negativity in the stock and the growth, we think there's a lot of value down here and on stock if you're patient, right? 19% growth is what is expected out here. If they can have a next quarter where they show 19% growth, we would bet that the stock would re-rate higher, and this is why we think that. $2 in share in EPS, which might be a little high as expected. Compare that to the $30 stock price, you have a 15 PE. You are buying a stock well below the market PE for a growth rate that is likely higher than what's going on in the stock market. That is usually a good place to buy stocks if you can be patient. However, the other side of the coin, if growth isn't there, you're probably going to have to wait a little bit longer to get positive stock price performance in OnCloud.